Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel. And today we have an amazing guest in Mr. Rhett Trees. Rhett is the founder, CEO, and Chief Compliance Officer at Seneca Capital Partners. Seneca Capital Partners specialize in niche, non-correlated assets that are generally in sectors that are not well understood, not overcapitalized, and do not fit neatly into traditional institutional asset classes. As one of the only registered investment advisors in the manufactured home community sector, Seneca is launching their third fund in 4 years with a keen focus on deploying another $200 million into the MHC market. From 2013 to 2017, Rhett was an equity partner at Caddis Capital Investments, the sponsor of Trico Fund 3, an equity vehicle levered to $75 million that sold most of the fund MHC assets to Blackstone in 2019. Rhett, thank you so much for coming on the show.
Andrew, it gives me so much pleasure to be here with you. As you know, I consider you to be a dear friend, and it's an honor. I think the best thing about our industry is the fact that we're all friends. I don't know that I've ever been a part of a business sector before that has been so welcoming and so familial. We often say everybody that's a part of Seneca is part of the Seneca family, and we mean it. Our investors, our service providers, what people would traditionally call a competitor, that doesn't resonate with me. We are all good people in this industry. I think we've got some great folks that are really adding a lot of integrity to the business, which was much needed. And we're just honored to be a part of it.
Yeah, no, I agree. It's great to know someone like you, and I'm excited to learn about your resume today. Maybe you could start out by just telling the listeners a little about your story and how you got into manufactured housing.
Yeah, I appreciate that. And listening to you, say my bio, it sounds much more impressive than it really is.
I don't know, man. That is impressive.
This has all been cobbled together, man. And it's truly on the shoulders of giants, right? I mean, you hear people say that, but it's funny. I didn't even notice it until just now. If you see that picture right above me, right there, That's our fourth generation farm in Indiana. My dad grew up there. My parents still live across the street from that photo. That house is no longer there. It was falling down when I was a kid. Farmhouse built in the 1800s. And if you look closely in the yard, which I actually used to have in our first presentation in our first fund, there's a 1977 Wilderness trailer underneath a big tree in the side yard of that house. And I've spent a considerable amount of time in that trailer. So I often say to people at our conventions, there's hardly anyone here who's actually ever lived in one of these things. So I've got that great distinction of, knowing what it's like to be someone who needs affordable housing. And that's why I'm so passionate about it. People often ask me, how did you get into this crazy business? And it's truly a lifelong passion. My parents are incredible people with the biggest hearts I've ever seen. And they were willing and able to help me move to a new school when I was in high school to play basketball at a different school. And we lived in a barn above a landscaping kind of a warehouse for about two and a half years. I lived there for 2 years. They lived there for well longer. And then they built a house on our farm. So I know affordable housing. I've been blessed since then, but that's the reason why I'm so passionate about this business and about the services we provide to our residents.
That's fantastic. And, I know you spent some time at Caddis Capital. Looks like you spent about 4 years there. What did you learn during your time there that you brought over to Seneca Capital Partners?
Yeah, that was kind of a big blessing for me too. I had been in the land business. I was a big land developer before I kind of got into the mobile home park business. I was also in the mobile self-storage business, which I loved. Mobile self-storage business was incredibly capital intensive, and not nearly as passive as I had anticipated when we started. There were 6 of us. We sold that to Waste Management the last day of 2009 for nearly $100 million. And I got into the land business after that. And I thought, I could help bring more affordable housing to the landscape. And we were literally buying large tracts of land from the national home builders and holding onto them, and turning around and reselling those tracts back to the same people we bought them from. And during that time, our investors would say to me, well, I'd love to have a little more return on investment during the hold period, a traditional IRR. And, you're writing 50-year business plans with your land developments, and it just doesn't resonate with people, except for large family offices who have legacy planning and really don't need the capital or return on that capital for an extended period of time. It's more of a return on equity play, right? Not an IRR play. And so I started to think to myself, how can we really activate this land? What's the best covered land play? And that's when I really fell in love with mobile home park investing, and started to say to everyone that would listen, do you know of anyone in this business? Because at that time, this is 2010. There weren't a lot of folks that were really in the business, especially sophisticated people. And I had said to my banker at the time, we were having lunch, and she said, oh, I've got the perfect guy for you. So I had lunch with Terry, I think maybe 3 or 4 days later. And Terry LaRue and I became business partners, and I'm eternally grateful for him, his knowledge, his friendship, and what we accomplished together was just 2 of us. And Terry had been in the business since 1986. He's in his 70s. I was in my early 40s at the time. And we really just knocked it out of the park. We had a ton of fun. He's a 4th generation Colorado rancher, so he sees the world in a unique light. And I'm a 4th generation Indiana farm boy. So I'd say that we're both conservative, which I think was helpful. We still built one heck of a portfolio that you'd mentioned. We sold to Blackstone, majority of those assets to Blackstone in 2019. And, I learned a lot about what to do, what not to do. What we do at Seneca is way more sophisticated now, I'll tell you that much, in regards to how we model, how we look at assets. In 2011, 2012, 2013, you could basically buy any mobile home park asset for an 8 cap or 12 cap. And it was really hard to mess up any of those assets. So we got really lucky. Freddie Mac came into the business in kind of that 2012, 2013 timeframe, and we were one of their biggest borrowers during that time, thanks to Art Tuberson, who was at GE Capital and is now at Berkadia, but longtime friend of ours we did a ton of deals with.
That's fantastic. Wow. Some big names that you mentioned there with humble beginnings. So I love that. This is a question that I ask everyone that I interview. What are the most important things that passive investors need to look out for when investing into mobile home parks? What are the top things? Maybe it's 3 things, maybe it's 5 things. What would you tell someone that's completely new, that just heard about it, and now they're, interested in diving in?
That's a tough one. I can tell you from my experience as someone who owns their own family office, who invests with a lot of others via passive investments, and someone who's a sponsor, which I think is a unique perspective on our world. It's a scary, dangerous place. It's based on due diligence, on track record, on people running the business who is a real steward, a real fiduciary. And that's the reason why we started Seneca as a registered investment advisor. I had been raising money in the MHC space from third parties for our previous funds at Caddis. And the thing I heard from everyone was, man, we've been trying to get into this space forever, but there's no sophisticated sponsor who's given us the check boxes that we're looking for, right? It was the registered investment advisor. Are you a true fiduciary for the investor? Do you put their interests ahead of your own? Can you put a reporting package together on a monthly, quarterly, annual basis that is institutional quality, that helps us go to our underlying clients and say, look what we've done for you. We've put you in this sophisticated vehicle that, we can easily know is above board and they're doing the right thing. And then, I think one thing that we heard especially was that no one was providing audited financial statements at the time. And that was something that was incredibly important to me. So we went to KPMG, and KPMG had never done a fund of our size. Wow. It was a very difficult sales job. I mean, I'll eternally be, thankful and grateful to Paul Nacco here in Denver at KPMG, because, we convinced them, like we had convinced our investors when we started Seneca, was with a really simple premise: do the right thing with the right people for the right reasons. And then we had this aspiration that we were very vocal about, which was to launch 5 funds in 5 years and to sell them simultaneously for $1 billion in the 2026 to 2028 range. And so we've been going about that very simple goal, which I think if you can outline your goals in a very succinct manner for not only your investors, but for your partners and associates that work with you, and for those that work with you in alliance with you, like our service partners. It's been a very easy thing to do, to say to our service partners, we're doing this for these reasons, and we want to stay inside that construct. And we've been rewarded for it. I think that's the hallmark for our success. And as a passive investor, I'll be honest with you, I know nearly every sponsor in the space, and I haven't found one that can match the criteria for my family office. And it's, I would say it's sad. I have aspirations for that to change. And thanks to people like you and others in our space, I think we're getting there. And I'd be honored to work with all of you, because I love this new crop of folks that are coming into our space. It's been a little bit, concerning and very competitive, but I'm grateful for it, because we needed a new breed of syndicators and sponsors to come in and really do what they say they were going to do. And folks like you have done that. And I'm grateful for you doing that, because it helps all of us.
I agree. And I appreciate you saying that. I'm definitely a small fish compared to what you guys are doing at Seneca, but people doing it the right way, and there's other operators, making the headlines of coming in and raising rents, but not improving the assets. And that's just not how we choose to do business. So, that's something I look up to you guys, because I've seen some of the pictures and things on social media that you guys do in your properties, and it's impressive, and that's the same stuff that we do on a smaller scale. So very cool. No, I agree. You definitely need to make sure that who you're investing with has the same integrity. That's very important. Rhett, what has been the biggest hurdle for you in this business?
Oh gosh. I mean, I'm so grateful and blessed, Andrew. I got such a lucky start with Terry and Caddis, and the ability to kind of jump off from that point. We had a track record with the sale of Trico Fund 3 that really helped. And then we've had some recent supplemental refis that have been super helpful for our investors in regards to returning capital to them, showing and proving that our business model from day one was spot on. We look at every asset in a really unique light. We look at every asset, and it has to have the ability to have a supplemental loan, a cash out refinance attached to it. In addition, we've done every loan in Seneca's history with Freddie Mac. Wow. They're a dear partner of ours, and we just wouldn't be who we are today without them. So thankfully, the construct of their financing package is such that everything we've done with them is a really low interest rate. It's got a 10-year term, a 30-year amortization, and we have 3 supplementals with all of our loan with an assumption clause. And those two constructs about the supplemental and the assumption are fundamental to our disposition strategy, which is to sell or have a sovereign private equity firm or a US-based private equity firm assume all of our loans and take over all of our assets in a single tranche, 4 or 5 funds in a single tranche. So we think both of those things are incredibly fundamental to what we do and why we do it. There's an underlying factor there too, which I think goes to your previous question, which is we don't do CMBS debt. We don't do bank debt. I've lived in that space before, and CMBS, I think you just get out over your tips a little bit when you start to look at CMBS deals because it becomes a little more broad. There's something that gives you a tremendous peace of mind when you know that a government-sponsored entity is doing their underwriting in lockstep with you, to have your seller servicer in the middle, and to know that, we've got this right. We did what we thought should be done right, and the debt agrees with us, and we've underwritten this correctly. They've come back with a similar underwriting, and that just gives me a ton of peace of mind because I've got the majority of my net worth invested in Seneca and our funds too. So there's all these checks and balances. And to your question about the hurdles or what's been the toughest part, I think scale is just something that we all struggle with in this business. I mean, if you get down to the real heart of the matter, you've really got to ask yourself, why does the tenant have to pay for this low cap rate environment? And I struggle with that. I'll be honest with you. I mean, I'm a really spiritual cat, and we run our business in a really spiritual manner. And that's been the hardest part about this recent situation in affordable housing and just housing in general in America is, the tenant really does take a lot of this brunt, because if you buy something at such a low cap rate, the only way to get yourself out of it is by raising rents or cutting costs. I mean, it's a really simple business. It's probably the most simple business I've ever been a part of. It's an NOI based business where there's really 2 levers you can pull. And you've got to kind of do them simultaneously or else the model just doesn't work. So, that's the struggle, I think. If you can find a seller that's willing to sell for a win-win price, which we struggle with, but we closed 3 deals in December alone. And I think if you went back and asked all those sellers if we were fair, if we were kind, if we did the right thing, I know each of them would say yes, because we've talked to them after the sale. And to be honest with you, they're our friends now. I mean, I really get engaged in the friendship of the business. That's what it's really about for me. It's not about the money. I could care less about the money. It's truly about, this is our existence. I often tell people this isn't my job. It's not my career. This is my life. I've got everything, tied up into Seneca, and, it's just how we present ourselves to the world more than anything.
Definitely. Yeah. And back to the hurdle part with the tenants and how they kind of bear the brunt of this. I think that mobile home parks, have been deferred, a long time. It's probably been with a lot of these mom and pops, 10, 20 years before they've kind of done some of the deferred maintenance that's been necessary. So I think it is a double-edged sword, like you're saying. The deferred maintenance and some of the capital improvements that are being made are being made, but as a function of that, lot rents, which it's been studied that they are low across the country. They're starting to go up. I'm sure now that COVID has happened, some of those have been paused. Maybe you could touch on that briefly, just how COVID has affected your guys' portfolio.
Yeah, I have, as you and I have talked about, I took a really broad view of COVID originally in the beginning. And I knew in my heart of hearts that having been through recessionary periods with this asset class before, that it was going to be resilient. It just always is. I mean, it's the last receptor for affordable housing in the country. It's the last bastion for anyone who needs affordable housing, and I knew that people would flock to this asset class, and they did. I give all the grace to Larry Nelson, our head of asset management. He was doing a stress test on our entire portfolio almost on a daily basis in the early April through middle of May range, where we were looking at our collections on a daily basis to ensure that we weren't getting out over our skis, that we were collecting all the rents, that our planned, what we called voluntary capital expenditures were still needed and we're still on track, and that we held back some non-discretionary or some discretionary capital expenditures to see where we were headed and what was going to happen. It was a very noisy time in that early March through April timeframe. And once we got to May 1 rents and we were 97% collected, I said to myself, this is one of those rare opportunities, a once in a lifetime opportunity for us to strike in a market that's been overheated, that we know is going to thrive no matter what happens here. Even the pandemic ran for 12, 24 months, that we were still going to be fine. We were flush with capital. We had Sire Fund 2 that had just closed. It was about a $90 million total AUM fund. So we had all that money at our disposal.
Wow.
And so I jumped in an RV and I was gone. I think we went to 18 states. I looked at 33 deals. I sent an email to every broker and third party I knew in the country. And I said, send me any deal, no matter where it is in your pipeline, and I'll see it in person in the next 3 weeks. And we did. We looked at 33 deals, and we looked at competitive deals. We dove deep into every market, and I was in a 32-foot RV doing competitive mobile home park tours, which with my two kids who were 11 and 8, and my wife who basically had no idea what I did other than hearing me talk on the phone, and for them to witness that lifestyle and what daddy does for a living, personally, I think was maybe one of the biggest gifts I've ever given my family. My kids came back with a whole new appreciation for not only our life, but just being empathetic for those who need help from us and others. And the fact that what Seneca provides is clean, safe, affordable housing for our tenants. And to our previous conversation, one thing that we're really proud of is if we do raise rents, we provide some type of amenity or benefit to the tenant immediately, if not prior to that rent increase, right? So if you look at our community in Dallas, since we bought it, to your point, also it had incredible amounts of deferred maintenance. The owner lived nearly 3 hours away. She hadn't been there in 8 years. They hadn't done anything to the park. We came in, put it in a brand new basketball court, a soccer field, a huge gazebo, a Texas-style barbecue pit that was, at 30 feet wide. Redid the community center. We've had families in that community center that have booked it every day of every weekend since we've remodeled it.
Wow.
And it gives me so much joy to know that all those people now have this community, right? Yeah. That's what we're in it for, is this community. But we forget about that part of what we do, that we're providing literal community, this structure for people to have these safe places where they can go barbecue with their friends or their family and really be a part of a community. And that's something that we're really proud of.
That's huge, man. No, I'll never forget. It was a gentleman that works with me. His mom is an artist. And in one of our parks, she said there was like a big, huge blank wall, right? When people come into the community. And she said, hey, if you fly me up there to see my son, I'll paint a mural on that wall. And so I was like, of course. So she came up and she painted a beautiful scenic, like mountain range with deer. And it was absolutely beautiful. And I'll never forget the tenants coming up after that. Cause I lived in a house in the front of the park during this whole process.
You lived there, yeah.
Yeah. And I'll never forget the tenants coming up and just saying, thank you so much. I've been driving home from work for 15 years and just hating, driving through this community just because it just looked the way it did. And now every time I see that mural and it says welcome home up top, and it just melted my heart. Just something so small like that can have such a huge impact. So love what you guys are doing, to increase the value of these communities that have just been, it's just, I don't blame mom and pops. I think they needed the income, so they just weren't reinvesting into the assets. So,
yeah, and I mean the difficult part is that they lived off that income forever, right? The mom and pop, and if anything, they didn't reinvest in the community. And I think if you put yourselves in the space of the homeowner, and a new like behemoth organization buys your mobile home community, what's your biggest fear? Your fear of losing your home,
yeah,
or losing the space that where your home resides, and the first thing we want to do is put all that to rest. All we do is own mobile home parks. B, the last thing we want to do is for you to leave. We want to do everything we can do to keep you to stay. Yeah. Like that's our job. We bought, a park knowing that we wanted you to be there. The last thing we want you to do is to leave. And I think in the tenants' minds, when you can come in and immediately make some kind of dramatic change, right? So we'll repave the roads immediately, or we'll add all these huge amenities. And more importantly, what we've been doing with Freddie Mac, which I think has been incredibly powerful for the tenant, is we've been putting in a significant amount of escrows into our loan. I'm talking $300,000, $600,000, $1 million for our most recent deal in Coeur d'Alene, Idaho, where we committed $1 million in escrow to capital improvements. Wow. Which is a huge amount of money.
Yeah.
And so I think if you're the tenant and hey, my rent's probably under market. And I think they do know that. They've done the competitive calls. They've called over to wherever and said, will you guys give me a credit to move over here? And they say, yeah, we would, but we're full. And B, our amenity package is less than where you are now. And C, our rents are higher than where you are now. I think the tenant knows, like, gosh, I'm probably getting a pretty good deal here. And if the tenant has their home paid off, I'll argue until, the end of time that mobile home parks are the best value on the planet in regards to housing. We typically look at 3 competitive sets when we buy something. It's a 3-bedroom single family rental. It's a 3-bedroom or 2-bedroom Class C apartment. Or, it's what the land value and the home value would be on a private piece of land. And so we look at all those and we say, let's try and be 20 to 40% of whatever that number is. And if you could do that, you're going to win all day long.
Yeah.
You're usually at the 40% number, right? So, but if you can be in that range in regards to your lot rent compared to those other asset opportunities for the tenant, it's a great value for both parties.
Huge value. Yeah, no, I agree. Rhett, this is another question I ask everybody. What does the perfect mobile home park look like in your eyes?
Oh, gosh. I think that's probably the toughest question on the planet. The thing that immediately comes to mind for me is potential. I call we've looked at, I think maybe $3 billion worth of mobile home parks in the last 3 years. Probably, I'd have to look at the number, but it's probably 150 parks, maybe more, 200 maybe. And I look at each of them as a potential child. I call them my children because they're all different, right? They all have their unique personality. They're on city water, city sewer. They've got this lagoon system that you can get half a mile away. You can get the city water, city sewer, and we take the risk on doing that. At the end of the day, if you ask my kids what I do for a living, they'll tell you that I'm a highly paid creative problem solver. And if you can really frame everything you look at in the mobile home park business in that view or with that construct in mind, then you'll notice that the entire world opens up to you because there's never been a perfect mobile home park. Our job, when I tell our investors, what we do for a living is we take assets that have been trammeled or, that are disenfranchised, that have had previous ownership that truly did squeeze every drop from not only the fruit, not only did they cut off the limbs of the tree, they cut down the entire tree, right?
Yeah.
So it's our job to really just go back and show that tree what its potential is. And we invest in it and we make it better. And if we can make, some money for our investors, when I wake up every morning, I have a really simple kind of meditation with myself. What's my job today? My job is bifurcated. It's to give money back, a return of and a return on to my investors, because they've given us their hard-earned money. And for every dollar they give us, my job and my goal is to give them $2 back. And our tenant. So I wake up and I think about, man, when I was living in that barn, what would I have wanted? I would want a landlord that would have been, heartfelt, but would have provided me the services to have a clean, safe community. Because I think our tenants have the exact same aspiration that you and I do. It's to provide a clean, safe place for our kiddos to grow up and for them to be better than us when they're of age, right? Yeah. So that's what we do. We provide that clean, safe community in hopes that everyone that lives there can find their way and their journey to become their best self. So that's really it. We try to make it a pretty simple process when we do what we do and for the reasons why we do it.
That's fantastic. And I mean, you've kind of touched on this throughout, but one of the last questions is, what is the value proposition at Seneca Capital Partners? And, what would you say makes your funds different? I know you have mentioned a few things, but maybe you could summarize it and tie it together here at the end.
As an investor, I think about that a lot too, like what separates us from all the people that are out there, because there's a lot of sponsors. Our space and our sector is probably the noisiest sector. And this happens every time there's a recessionary environment and there's a chase for yield, right? So the multifamily guys come to town, the industrial guys start to sniff around. And it's the folks like us that traditionally end up buying whatever assets those people bought 3 or 4 years later because they had no idea what they were doing, which is fine. We're happy for them to overpay and for us to get a discount in the future. Patience is rewarded, and we're in this for the long term. I'm not going anywhere. I plan to do this for the rest of my life. So, what differentiates us, I think truly, if you asked anyone who's been a part of our journey, they'd tell you that our hallmark is creativity. I could give you example after example where people have walked away from deals or signed us deals, or we've got deals off market because people just weren't able to think creatively about how can I find a win-win solution for the seller and for us and our investors. And then in the future, find the highest and best use for this asset, regardless of what it is or how it looks today, right? So, we did a park in Florida where we escrowed $600,000, replaced 166 6-pad cement parking pads, and we've already completed it. It took us about 6 months to do that. We're putting in a water pad, a splash pad for the tenants right now, and we've taken that from what the seller told us was the last bastion for affordable housing in the county of Florida where we are. Wow. And we changed the thought for not only our management there, but for our tenants, that no, we are the cleanest, safest, coolest place to live in the mobile home park community in the area. And not only that, we're going to invest in it and show you why. And so we took what I call a sub-institutional asset. It's 170 pads, and turned it into an institutional asset. And so, the way that we do that, I think, and you and I have talked about this in the past too, one big differentiator for us is the fact that we've just got 150 like new road ready mobile homes sitting in 2 storage yards across the country. And when I started doing that, that was a huge risk that we took. And I honestly was kind of like, yeah, I think this is the right thing to do. But to have millions of dollars sitting in a storage yard that's burning at an 8% preferred return, fallow capital, and a depreciating asset, anybody in the structured finance world would go, yeah, man, I don't know. What are you guys doing again? But when you can step back and look at how this business even works, which is what I call this lot activation strategy, right? So if you can get an NOI on that home and that lot with an asset that you bought for 20 cents on the dollar, you sell it for its retail price. So even if you make money on the home or the chattel, it's a win. I'd sell it at cost if I had to. I'm in it for the lot rent because then I get to capitalize to put the cap rate on that lot rent. And I just activated that lot, and now I get credit at a compounded rate for all that income. And so that's really the reason why we did it. And it's now started to catch on with people that was genius. And I'm like, well, it didn't feel so at the time. It still doesn't feel that way right now.
And maybe you can explain, a little bit deeper into that risk that you took, because, when you told me that, I was at a loss for words that you took that risk. But now, it speaks to your creativity that you were talking about earlier.
Well, at the time, right, the manufacturers of mobile home chattel of homes, they were rapidly declining, right? And so what was the most difficult part of our business was it was impossible to find a used home. If you did find one for sale, it probably wouldn't move. They're like anything else, like your house and my house. They settle and they get comfortable where they are, and they don't want to go anywhere. I mean, you got to remember there's 2 steel beams that run underneath these things with a hitch tied, welded to that process, that foundational process. And once I call them single purpose vehicles, their purpose is to get where they're going, and they're never meant to go anywhere again. The mobile aspect of what we do is really a misnomer. And so I thought, well, what if we could get these like new homes, and we bought them from the federal government in bulk, 10s, 20s, hundreds at a time.
Wow.
And if we could, what if we just had them? And what if we could go buy mobile home parks that were 50% occupied in thriving 24-hour cities that had, we look at really 3 things when we buy a mobile home park: population growth, income growth, and the dislocation in the ELI index, right? It's an index provided by HUD. It's a map, a literal map of every county in the country. And it will tell you how many units are available, how many people need affordable housing, and how many units are available for that contingent. And so what happens is that cohort's going, man, I would pay anybody nearly anything to have a home right now. I don't want to live with my mom and dad anymore. I'm living with my brother. Who knows what they're doing? And what gives me so much joy about what we've done, and I told people this from the beginning, I don't think they really understood, was I'm so excited to add supply to this business, because it's a demand-driven, supply-constrained market, right? So there's just not enough of it. And nobody's willing to take a risk and say, you know what? I'm going to add supply to this thing instead of building a Class A apartment complex that's going to rent for $2,300 a month to a 26-year-old who has a $72,000 salary in a market that's overbuilt by 9,000 units. I'm going to go to the other end of the spectrum, right? So I'm going to add supply to the most affordable aspect of housing. And it resonated so deeply within me that I just knew it couldn't be wrong. And so we've sold through about 80% of those homes now, and we're trying to buy more of them. But I think the secret's out. I've been talking about this for 7 or 8 years now. So some people have caught on, which is great, because at the end of the day, we need a bunch of us, me and you and everybody else, to add the supply. Yeah. And so I don't care who adds the supply. Let's just add it so these people can have a place to live, so we can solve for homelessness, and we can solve for some of these societal issues that literally do keep me up at night. And that's the reason why we started our family foundation, to kind of solve for some of these things that, really do, keep us up. And so, that's the main reason why we do what we do. And what kind of differentiates us is just this our ability to add new supply in homes.
And that, as you were mentioning that, I thought through about a handful of other interviews that we have on the show, talking about the value add components in manufactured housing communities and how infill is, the hardest aspect. It's easy to come in and to raise rents, right? But to infill requires more labor, more work, more risk, more capital. So kudos to you guys for not being scared of that and for taking the initiative to put those homes to work. You guys really worked hard to make that happen, and you took a risk. So that's awesome that it's paying off for you.
Yeah, I appreciate that, my friend. I know you've been doing the same, and I'm grateful for it because, your work is harder than ours. You're down in the trenches. I mean, the one thing that I'm really grateful for, and I have to say it, is Mark Kassab and his team over at Shapiro. Without Shapiro, we wouldn't be who we are today. I'm just not built for the day-to-day management of what we do. And gosh, man, I tell you, the folks at M. Shapiro have really changed our lives for the better. I think the industry for the better. They know what they're doing. They've got their own portfolio of mobile home communities, and then they're doing it for others, which I think was the reason why we couldn't get this institutional view of the industry. It's like self-storage. I always say to anyone that'll listen that mobile home park investing is self-storage in 1988. There were a bunch of these mom and pop developers across the country who took a ton of risk to buy a piece of land, develop it into whatever they wanted it to be, to try and get a brand going that was almost always Orlando self-storage or, local yokel self-storage. And, to have the institutional backing of Public Storage and others, was huge for the valuation, the compression of the cap rate in that business. And I think we're seeing that now. And I think folks like M. Shapiro will help bring some institutional views to what we're doing and why we're doing it. I think it's already here. But that's really what we do on a daily basis is we're doing the heavy lift for the institutional owner because they're lazy. Let's be honest. I mean, it's going to be whoever we sell our portfolio to is going to be a 28-year-old kid on Broad Street in New York City in Manhattan, managing it from a spreadsheet.
You're more than likely right on that. And maybe you can share a little bit about Shapiro. I know they're like a third-party management company. I've spoken with Shapiro. I think it works better for your model for them to manage your parks, with 150 lots or higher. And, maybe you could talk on some of the, the strengths and weaknesses of their operation.
Yeah, I'd love to be honest with you. We had a really unique start to our relationship. I remember sitting down with them at the NCC in Chicago. We had just started with them. And they didn't really do what we thought they were going to do in regards to this handoff process for our first asset. And I remember that lunch. I'll never forget it. I mean, we were sitting at a pizza place in Chicago and I was pretty rough on them. And I'm usually like super chill. It's pretty tough to get me fired up. And, I said, you know what, guys, this is not the partnership that we had in mind. And Mark Kassab looked me in the eye at that lunch and said, you know what, we're not proud of this, the way that it came off either. And we learned from it and Seneca learned from it. And we were like, sweet, well, let's go do this. And ever since that day, they've never said no. We bought a 5-park portfolio in Wisconsin. And the biggest one was in the high 300s pad. And the smallest one, I think, was 17 pads.
Oh, wow.
And they took it all. And they said, you know what? Doesn't matter. We'll figure it out. And so, there aren't very many other folks in our business that would have said, yeah, we'll take on a 17 pad mobile home park. And then the tertiary location, that's 40 miles from the nearest anything.
Wow.
And so, that's why I'm so proud of them. I mean, they've built a professional organization that thinks of themselves as best in breed and world class, and they are. And so you're right. People, I'd love to be a mentor to folks that are just getting started in this business. And I take any phone call from anyone. And I've talked to so many people recently mainly young folks who are in their late 20s, early 30s that want to really get started and do it more from the bootstrapping side of the business. And I think that's the toughest part is, you've got about this 500 pad, demarcation line, right? Where you've got to bootstrap it to 500, and then you may have enough income, but if you don't have any outside investors, I'd argue, and I know that Ian and Ryan would probably argue, and that you would argue, that you're likely better off to just own the whole thing and not have these outside investors or these enormous aspirations, because there's this no man's land, and we were in it about a year ago where you're big enough to be big and you're too small to be big, and it's so frustrating because you're like, man, these costs are eating us alive.
And the management,
we've got a lot of costs.
They kind of all
investment advisors, so we've got this overlay on the corporate side. And we've got a fund administrator, and we've got KPMG as our auditor. So we have all of these like third-party services that weigh on us. They're an albatross around our neck that folks that do more of the bootstrapping route really don't have that cost center that they have to worry about. So I think that's the fascinating part about the business, because the barriers to entry are so low. I mean, anybody can be an owner in our business, and I love it. But that's the conundrum is, I often say it's a scale business, because the cost line stays static, right? And I know you felt this pain. We've talked about it. And if you have a 300 pad park and the cost line stays here, man, there's a lot of money in the middle. But if you've got a 58 pad park, which we've got one in Texas that's just been, our crazy child.
Do you want to sell it?
I do, actually. I'd gladly sell it to you because you'd figure out what to do with it. Lord knows.
That sounds like a base hit for us. But yeah, we'll talk about that after. But
exactly.
No, you're exactly right. The scale is the tough part, and building that management team is difficult. So that's really good though that you've had a great experience with Shapiro, and there's been other people that we've spoken with that have had horror stories with third-party managers. So
those two, believe me. And when I was at Caddis, we really tried. That I'm grateful and thankful for that time, because we tried both as a pilot on purpose, right? So we had an in-house management team that was really small, trying to manage a couple of properties. We had a third-party manager, and in my experience, if you do it in-house, it's twice as costly, and we were half as efficient. But to our point, like, you've got to have the scale for all that to work. So at Seneca, we've done what we call hybrid, where we've got Larry Nelson, our head of asset management. Larry's just an incredible resource. The guy's a wealth of knowledge. And he's kind of the oversight for Shapiro, and then, all of our on-site property managers in the regional managers. So we provide the strategy and the go-to-market thinking around what we'd like to accomplish there, and then we work in lockstep with them. Larry has a huge call with them every Monday where they go through every single asset, and it's detailed. And we use a third-party solution app that I think has been kind of mind-blowing and game-changing for all of us to have these insights and keeping people accountable to what they were supposed to do after the last call. And you're better than anyone at this is the process of what you do, and utilizing as many tools as possible to make that the most efficient time for everyone in the entire chain. And I know that's how you've grown your business, and I've just loved watching you grow and be a real shining light for the industry with this podcast and with the way you do business and being a friend to everyone. So thanks for that. And thanks for having me.
I really appreciate that, Rhett. That means a lot, man, coming from you. And, you're an idol to me in this business. So I'm really thankful and grateful that you chose to come on the podcast. If any of our listeners would like to get a hold of you, or might be interested in investing with Seneca Capital Partners, how would you like them to get a hold of you guys?
Oh man, that's too kind. Yeah, my cell phone's out there, and I'll give it to everyone right here. And I encourage anyone to reach out to me. I mean, I've had folks that have never even known much about the business. I'll spend as much time with them as they want. I think just if we can educate anyone about the business and the positives about what we're doing here, I'm happy to spend time with anyone. And if I can be of value, they can call me on my cell. It's the only number I have, 303-888-2826. They can reach me on email at rtrees, TREES, at Seneca, SENECACP.com. And we have aspirations to launch Fund 3 here. We're going to do it this month. We were going to have a cover number somewhere in the $50 million range. I think we're probably going to double that to the $100 million range of equity for $200 million in AUM. Ideally is where we're going to hopefully end up. So we've had some incredible investors with us along the way, and we've got a great advisory board. I encourage you to check out our advisory board on our website. Some of the brightest people I've ever worked with. I'm incredibly grateful for them and their guidance. And if anybody wants to learn more, I'd be happy to tell them about the industry and why we think we're so long on everything that's happening.
Awesome. Well, thank you again, Rhett. I think there was several golden nuggets in this episode for our listeners. So that's it for today, everybody. Thank you all so much for tuning in.
It's a pleasure. See you, my friend.
Hey, are you getting value out of this show? If so, would you mind please going over to iTunes and leaving the show a quick 5-star review? I have a goal of hitting over 100 5-star reviews by the end of 2021, and it would mean the absolute world to me if you could help contribute to that. Thanks ahead of time for making my day with your 5-star review of the show.